that same passion with Cyber Trading University and Fausto, and I just you feel when somebody's passionate about what they do, and it really shows in how they communicate and how they bring the information to you. So I hope I excite you a little bit today about the markets, because what I'm going to talk about is trading low risk tops and bottoms. But before I get into that, we are behind screens, we are behind computers, but we are people, and we have a lot going on outside of trading, and that's the one thing that I love about the trading profession, is it allows me the flexibility to take on a whole lot of new things and a whole lot of things that I don't get to experience, and relationships that we get to build, like with Cyber Trading University, and there are events that we get to go to and things that are associated with trading. If you've never been to the money shows in Vegas or New York, they're great places to network and meet people. So I am happy to be here, and I hope you get a lot out of today. I know I've done this presentation already, a couple of times, and it gets better and better. But before we get into the presentation, we are going to start talking about a little bit of risk. And just know that the charts that I'm showing and the trades that I'm showing, actually a lot of them are real trades that I've taken, but there are a few hypothetical examples that I'm going to show you. And here's the CFTC rule that most people have to begin with. I am registered in the state of Virginia as an investment advisor. I do need to disclose that. However, I am not here today speaking in that capacity. I'm here as an educator. I'm here to teach you how to manage your own money. I'm not making any recommendations to buy, sell, or trade any securities. Make sure you know your risk. I'm a small town guy. Now, I moved to the big city, and I've lived in the big city for quite a few years, and trading has allowed me to spend most of my time in a small town now. I call myself retired at the age of 30, and that's when I kind of started my trading career. Actually, I started when I was 29, but I went full-time shortly after my 30th birthday. So I do get the ability to kind of keep up with the New York scene and the Chicago scene, and get the benefits of being in a big town through the internet. However, I do live in a small town. It's called South Hill, Virginia. I graduated from Old Dominion University. I was in corporate America for 9 years, and that was about 8 years too much. So for those of you who've been here and been in corporate America, or are in corporate America right now, I understand what you're going through. I understand going into a little cubicle, and the trading profession has offered me the way out of there, and I hope it offers you the exact same, and I hope I can help get you there with what I'm going to go over today. I have been a professional trader for a while now, and founded a website called TradeTheSystem.com, where we focus on discipline and a lot of futures trading. So like Fausto said, it's the same information with a little bit different twist. And I think, I can say that it's like when your father is telling you, how to ride a bike, and he can tell you and tell you and tell you until you experience it. Sometimes it doesn't hit home. And then sometimes your father can tell you the exact same thing as a stranger, and you won't listen to your father, but you'll listen to a stranger. So I know we find that, and we're just like Cyber Trading University. We like to invite others to get others' views, because we know our members can take a nugget or two from them, apply the teachings that we've been able to get through to them, and they can improve their trading and make their own plan. And I'm going to talk about that for a slide or two here in just a little bit. But before I talk about the X's and O's, there's one overlying thing that I like to begin my presentations with, and that's why, how big is your why? And I stole that from some of the self-help guys. I know Tony Robbins stole it from somebody else too. So I'm just borrowing what they have, found to work. And, when you ask that question, when the why is big enough, the how is easy. So my why was big enough. My why was big enough that trading became my how. There are a lot of ways to make money in the markets and, in general. I mean, you can find, it's a little harder to find jobs, but you can create opportunities for yourself if you'll just keep your eyes open. The big question is, how hard are you looking, and how dedicated are you to making, a go of whatever profession you choose to embark on. My why is very, very big. My why consists of my 2 boys and my wife. And in order to live in a small town and still keep the lifestyle that I liked in the big city, then, you know, I really couldn't work for anybody in the small town. I had to kind of create my own path and create my own wealth from, in this case, it ended up being trading, and I fell in love with it. I used to be in real estate. I tried real estate, and when I left corporate America, I actually thought that's what I was going to do. I thought I was going to be a real estate landlord, and what I found out was I could do the exact same thing in the markets. I could generate income from the markets just like I can from real estate. So that's what kind of, I didn't have to deal with a lot of the headaches of the plumbers and everything. So that's why I trade. I trade to support my family and to make sure that, you know, I can give them the opportunities that, you know, some of them I had. I didn't grow up, you know, dirt poor or anything, but I did not grow up, you know, I was pretty much middle class. And, you know, I like to be able to take my family to places that I really didn't get to go and do things that I really didn't get to do. Like I said, I don't regret my childhood at all. It's made me who I am today. But there were things that were limiting to me that the trading profession and the flexibility that trading gives you will open some doors for you. So when your why is big enough, the how becomes easy. And one of the hows, one way you can embark on this trading journey is through having a plan to trade low-risk tops and bottoms. And that's what I'm going to talk to you about today. I hope that by the end of this presentation that you will have a tool in your toolbox. No, this is not a standalone tool. This is not a tool you're going to pull out and say, hey, I'm going to, you know, beat the markets with this one tool. I want you to use this tool as a complement to your strategies, a complement to the other things that Cyber Trading University has taught you, that I'm going to teach you, that, you know, other people that you view this week or this month or next year can bring to you to give you that edge on the market. And the first thing I'm going to talk about is making sure you have a plan. If you don't have a plan, then I have yet to find that one indicator, that magical buy and sell button. And if I do, I'll be the first to, you know, to let you know that I found it right as soon as I, you know, keep using it for long enough for me to go to the beach and retire, you know, truly retire. Because if there was truly a buy and sell indicator out there that was 100% accurate and just made you gobs and gobs of money, I'm going to guarantee that you would probably never hear about it, because whoever finds that, the holy grail, so to speak, is not, they're going to keep it under lock and key. But the holy grail is right in between your ears. It's having a plan. It's thinking about your trading as a business and then treating it as a business. There's nobody in this, and like I said, Cyber Trading University, Fausto, you know, the group that I'm with, Pat, he's another moderator at Trade the System. All of the people that I look at across this business, we mentioned it before in the introduction, we have one thing in common. We have a way to attack the markets that skew the probabilities into our favor. So I don't care, you know, what you do. I'm going to give you a quick little plan. This is by no means a complete trading plan, but it is a method that you can use and keep in your memory banks to at least have some structure to the way that you attack the market. Okay, you've all heard, you know, the adage, plan your trade, trade your plan. Well, that's very important. And here at Trade the System, we have a 3-step thing, because anything, I told you I'm from a small town, and you know, corporate America, there was a whole lot more smarter people there that I worked with, but I was able to blend in, and I have to keep things simple. And if you give me, you know, 20 different steps, I'm going to remember about 3 to 5 of them. And so we've kind of condensed our trading method into 3 different kind of steps. Very easy to remember. Number 1, you have to identify the trend. And I'm going to tell you that there are a lot of ways to identify the trend. I'm going to give you a couple. But more importantly than identifying the trend, you've got to identify the phase of the trend. So there are multiple, if you're familiar with Elliott wave, I think there's like 5 waves to the upside and then a correction pattern. So, you know, which part of that plan or which part of that phase of the trend are you actually at? And we're not going to talk much about that today. There's a lot of ways that you can simplify that. Like I said, I'm going to show you a couple of different things. But we're going to talk about the trigger, your specific entry criteria to keep your risk low. That's what I'm going to focus on today. And then the supervision or the management of the trade. And I want you to do that objectively. I don't want you to sit there and start counting, you know, the vacation you can take off the trade you just made, or the, you know, the car you can get, or the new tires that you're going to get, or, you know, the light bill that you're able to pay, or whatever it is that you're looking at on your P&L. I don't want you looking at that to supervise your trade. I want you to look at objectively managing the trade and think about it before you actually make the trade. Don't sit here and make it up as you go. So we're going, and the one thing that I've told you, and I'm going to be very honest and as straightforward with you as I can, I don't care if you don't use my plan. If you've got a plan that's working for you, like I said, I hope to complement that by reducing your risk or increasing your entry, the specific criteria you have for your entry that will give you an edge or a bigger edge in the market. So I don't care if you use our plan, but have a plan. And I know Cyber Trading University has some help available for you there, and the guys and people there will be more than happy to help you work out your plan and incorporate, you know, the rules that go with that. So get a plan before you start partaking in trading of the markets, okay? So now that we've got all the overhead and the housekeeping issues taken care of, you know you need a plan. Let's start talking about one key aspect of that plan, and that's how do we identify tops and bottoms? You know, which direction do you take the trade in, and when do you take the trade? Today, perfect example, and I love when the markets give you great examples that are real recent. So at the end of this presentation, I'm actually going to flop to a live screen and show you kind of some things that went on today so that you can kind of see them in the live market condition. Because today was a really good example. If you did not have a plan of attack, you could have very easily today been swallowed up by the market. Just because your emotions, when we open down on the Dow, you know, 150 points, there's a lot of emotions that go along with those trades. People are seeing, you know, Hawaiian vacations. People are seeing, you know, all sorts of, you know, money to be made because, oh, the world's ending, the market's going to go down, you know, we'll be down 500 points on the day. And then all of a sudden, we almost filled the gap today and got back to unchanged. So you've got to have a way to spot these opportunities in the market, and that's what I want to talk about. Before I talk about that, though, we've got to get some terms and conditions down. And these terms and conditions, some of you've probably heard, you've seen, but like I said, I might put a little bit different twist. And when I talk about pivots, I'm not talking about those calculations that, you know, people use to fade pivots like R1, S1, and stuff like that. I'm talking about price pivots. So I want to get us on the same nomenclature, if you will. I need the vocabulary to be consistent, and what I call a pivot, I will be referring to as price pivots. If you have pivots in your trading toolbox already, then we need to come up with another name for this. But what I'm going to tell you is pivots do have a place. And if you're using the predictive pivots that are in your toolbox, this will definitely complement that strategy. But for the next 45 minutes, I want you to eliminate those type pivots from your mind and focus on price. And what I'm going to do here is I'm going to introduce you to a price pivot. You've heard it called a swing point. It's real basic. You have a red candle and a green candle. This creates a swing point. The lowest point on that bar is actually the pivot low. But a lot of people overlook these things, and a lot of people in spotting tops and bottoms overlook the difference between a simple pivot and what I'm about to show you as a complete price pivot, okay? These are like I said, they may be new terms, or you may have heard them referred to as something else, swing points, or whatever you've heard them referred to as. But let's look at the difference between what I call a simple price pivot, which is just a bar that closes in the opposite direction of the previous bar. So in a choppy environment, you're going to have simple pivot, simple pivot, simple pivot. But in a trending environment, a lot of times we get what's called a complete price pivot. And what we're looking at here is down candles, and then just because you close higher doesn't mean anything. So what you have is the pivot, the price pivots, the simple pivots are going to cancel each other, and you're going to look to your previous bar. As soon as you take out that high, then you've got a confirmed bottom. Now, why is this important? Because we need places to evaluate whether the market is getting stronger or weaker. And this is how we're going to do it. We're going to need a complete price pivot as well as a combination of a series of simple pivots in order to get us that low-risk entry. And when you see all this come together, this is just like a building block. My 3-year-old loves Legos. He likes the great big old Legos, and he'll stack them on top of each other. That's exactly what we're doing here. We're starting off with one block, and the next thing you know, we're going to have a complete structure in place. And that structure is going to be defined by the market, and that's how we're going to gauge our risk as to whether or not this is a high probability for us to make money or not. Now, notice I didn't say high probability to be right, and that's two different things. Being right and making money often don't go hand to hand. I am, in this particular setup, I am right more than I'm wrong. However, on certain days, if you get caught on the wrong side of the market, you're going to be wrong more than you're right, and you're still going to make money. And you're going to say, well, Michael, that doesn't make any sense. But the thing is, it only takes when you spot the top or the bottom, and think about this. If you spot the top of price, if you short the high of the day, or you buy the low of the day. Well, if you do one of those two things, that one trade is going to offset a series of losers that you could have had, because you could lose 5 points, and then make 30. You're only 33% right, but you're still making money. So anybody who tells you that your win rate alone is all the difference in the world, that means nothing by itself. Your average winner versus average loser means nothing by itself. Okay, and I may add that one slide. I've got a slide that shows it used to be a yellow brick road, but now it's a money flow machine. It's the path of the money flow, and it shows that you can make money being 98% correct, or you can lose money being 98% correct, because your win rate by itself means nothing. Okay, we're going to talk about why the win rate means nothing by itself and the combination of the win rate versus the average winners, and we're going to do it in context of price pivots. Okay, because at this point in this chart, you see these two red bars and the two green bars. At this point, I know exactly how much I'm going to risk, and that's half the battle. Because I know at the close of this second green bar here, I know that if we take out, under the right conditions, if we take out the low of this pivot candle, this little red candle here, the lowest point on this move, I'm wrong in my analysis. Okay, so that's the risk that I'm going to take. Let's say this is 25 points. Well, I know that a move like this, I need structure to be present that will offer me at least 25 points. Now, how do we do that? There are a couple of things that we can use to do that. I don't know if you guys are familiar with average true range, but the average range of the market gives you an automatic amount of money you can make. So what you're going to do is, like I said, we're going to complement other things with this method. So if we've got a complete, let me get back to the building blocks here. You've got your simple price pivot, and this is a complete price pivot. All that means is we've got a big enough move to close over the series of swing points. Now, it takes 3 bars to do this. In this particular example, it took 4. But you can get a bottoming pattern with 3 bars. So if you're using a 5-minute bar, I'm going to see how many people are paying attention here. If you're using a 5-minute bar, how long do you have to wait to make sure you've got a bottom? Well, actually, I can't see the question, so I'm going to have to answer this for you. You've got to wait 15 minutes. So I hope you guys said 15 minutes. Because you're going to get that bar completed, and you're going to have 15 minutes of history, and you're going to know where your risk is. So let's build upon this. Let's put a couple of these blocks together. Let's put the market structure in place. Notice you have a simple pivot, which is your first heads up. Then you have your complete pivot, and this is all I did was cut out a couple of these places, right? So what I want to iterate or show you is a simple pivot begins this process, and it gives you a swing point to gauge the strength or weakness of the market in relation to another swing point. So in this context, where obviously price is coming down, we're looking for a bottom, okay? Now, the key to looking for bottoms is not to every time you see a green candle take a long position. That's not going to work too well for you. What will work is if you can have something, and we'll get to this, but there's got to be something that is going on in the market right here where the buyers step in and they get a little more aggressive. They get a little more aggressive and close this candle in a green fashion or in an up move. And then up, they're not aggressive enough to take it higher. But right down here, we make new lows, and we take this candle right here says, oh, well, the buyer stepped in here, but they couldn't hold it, okay? Well, on this next candle, we know who's in control now. We know the bulls are in control, and we know when they're going to relinquish control, because the Japanese have used this, so the rice traders use these candles. So they wouldn't keep on using them if they didn't work. And when you have this structure in place, there's got to be some way to identify this as a potential bottom in relation to this move right here. And that's what I'm going to show you, and that's what I'm going to focus on today. And the inverse is absolutely applicable. Okay, you can have an up move that gives you these reversals in the exact same fashion. All you do is flip these around. This would be a new high. This would be a higher high. Now, how are we going to evaluate that? There's a couple of other things that I've got to introduce you to, and all of you know this. But when I'm just talking about price and structure and price pivots, the importance of these pivots, the importance of what I've just shown you, can be used by itself. Now, it takes studying of the charts, and it takes a really, really good eye, and it takes time. And a lot of times, if you're trading now a 2-minute chart, you might can get away with drawing lines on a chart. But if you're trying to use a small time frame chart to get a really low risk trade, then you're not going to have time to sit here and draw a bunch of lines. You're going to have to be able to spot these patterns pretty much instantaneously. And right here, we've got a bar. Here's the high of the bar. Here's the low of the bar. This is a swing point. You can see we've got some bullish engulfing. We've got a bottoming structure. You've got 2 simple price pivots, and well, actually you got 1 simple price pivot, and you've got a complete price pivot right here, all in a 4-bar pattern. That gives you this little pivot low, and you can see how that's respected. You guys have all heard this. I'm not making anything new here. You all have heard once support is broken, it becomes resistance. That's what trading tops and bottoms is all about. Spotting some support, spotting some resistance, and making some low-risk trades. Now, how do we do that? And you can see, if I haven't built your belief, pull you a chart up. Pull you a 5-minute chart up of crude today. Pull you a 15-minute chart of gold. Spot these little areas. Draw you some lines. Now, it's not an exact science. Draw you some areas, and see how price acts when it breaks through and when it comes back to it. Now, if you're trying to trade every one of these moves, you're going to be what we call you're going to overtrade. So be patient. Wait for the higher probability areas. This is one way to get you a higher probability area, is to watch these complete price pivots. Watch these simple pivots. Draw some lines on your chart, and when it breaks through and comes back and tests, you'd be amazed at how many times it magically finds the bottom or top at these levels. Okay? So let's talk about oscillators. What are oscillators? You all, I know you've used them. You've used CCI, MACD, price channel, RSI, or stochastic. There are probably 15 or 20 different other ones, okay? These are the most common. These are what you're going to find in most software packages, okay? So an oscillator is nothing but an indicator that goes from overbought to oversold. Now, why is that important? Well, I told you we were missing one piece when we had the price on the chart. We didn't really have anything to gauge how price was strengthening or weakening. Okay, we're going to use oscillators, and whichever oscillator you want to use, I'm going to, like I said, I'm going to take your building blocks. we're going to build a structure. If you want to put shutters and gutters and, you know, storm windows and, you know, a wraparound porch or whatever you want to put on it, that's fine. I want to give you the foundation or your structure for building your complete trading plan. Now, if you like what I do, that's wonderful. You know, I can definitely teach you the whole, you know, cabana, I guess, the little beachside cabana. We can give you that whole structure, windows, doors, and everything. But this is one component, and I'm not going to force feed any one of these components on you. I'm going to tell you that each one of them has its own use, and each one of them, depending on the type of trader you are, you're going to gravitate towards, you know, one or the other. If you're more of a swing trader, you're probably using the MACD right now. If you're more of a scalper, you're probably using the price channel or the stochastic. You know, if you're that intermediate trader, maybe the CCI is what you like, or the RSI. I want to show you how to use these in relation to watching price, okay? So let's take a look at that. And what we're going to be talking about is divergence. I don't know if you guys have ever heard the term divergence, but it's a very, 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 very powerful way to view the market. And what you're going to do is you're going to compare those swing points that we talked about to the oscillator that you're going to use. So what is divergence? Bearish divergence is when price is going up and the indicator is getting weaker, okay? Real simple concept, right? You'd be surprised at how many people, when price is going up and the indicators right here, are buying these breakouts. They love to be a breakout trader, and they pay no attention to the hidden clues that the market's giving them. Okay, I love that pattern because it does two things. It sucks newer people in on the breakout, so it adds more fuel to my fire in the opposite direction. Now, this is a counter trend strategy. I'm going to show you a twist on it, because when we look at it from a counter trend standpoint, you're going to say, well, Michael, you know, that's great, you know, but how many times are we going to break out and only retrace a little bit, and I'd have been better off buying the retracement than shorting the rally? And that's a very valid point. That is a completely valid point, because we've all heard the trend is your friend until it ends. Well, this is where we're anticipating the trend is going to end, okay? Now, what happens if we're seeing this pattern on an hourly chart? Then we have a much, much better chance of it ending than if we see it on a 50-tick chart or a 133-tick chart, right? So on a 133-tick chart, what do you think we want to do? We may want to be following the trend, right? Spotting the retracements along the way and looking for those subtle patterns or those hidden clues that the market's providing us. But I'm getting a little bit ahead of myself. Like I said, we're going to pull all of this together here in just about 5 minutes. So bullish divergence, it does have an evil twin, bearish divergence and bullish divergence, where price is making new lows and the indicator is making new highs. So again, these two associations or price patterns they're my best friend. It's what I have built my trading plan around. And when you start looking at this, it's the only reason that I like it so much is because I control my risk. If this thing keeps going up and this indicator breaks this trend line, your trade is over. You're done. You know you're wrong. Get out. Live to fight another day. Okay? So we're going to take this and I'm going to show you an example. The market's trading around. This is the Russell, and it doesn't really matter. You can do crude oil, gold, bonds, stocks. There's one caveat with stocks. If you're a stock trader, you need to make sure your stock trades some decent volume. You're not going to be able to do this on a stock that trades 25,000 shares a day. You're going to have some type of volume because we need liquidity in the market in order to judge these moves. Most of the indicators are volume, price, or time-based, or a combination of any one of those three, two of those three. Okay, so if we've got that, then we can build us a very comprehensive view of where the market is. So we're going up, and we keep, we're making new lows, we're making new highs, so we've got ourselves an uptrend. Well, what's going on this uptrend? Every time we make a low, new high, the indicator is getting higher. Now, notice we get an equal high here on this up move, But what happens when the market takes out 1,086 in this example? The indicator down here, and I'm just using the stochastic, the indicator almost goes out of the overbought range. It was extremely overbought, and now we're headed down and headed back down, and we're going to oscillate to the oversold condition. Now, you don't know this when it's happening, but look at the difference. You spot the higher high, the equal high, and the lower high. Well, you've got nothing but higher highs here on price. At this point on this red bar, we know two things. We know the market may head down. It's more than likely going to head down. Why? Because we're weak. We're getting weaker. There's not enough buyers stepping in as we make new highs. Okay, and we know another thing. We know that if we take out, and I'm going to round and say that this was the high was 1,086. If we take out 1,086, we know that we're wrong. We know we're absolutely wrong. Okay? Now, that's two key components to making a winning trade. What do you need to do to make a winning trade? You need to be, correct for the time frame that you're trading. So we know that if we sit here for 5 more bars and the 5th bar takes out this 1,086, we know our pattern's invalid. But we also know that if it does start moving down, we've got multiple places that it could go to. The first place, obviously, we're there at this swing point. You've got another swing point here. You've got a complete price pivot right here. So we already know we could have a move down here to 11 or 1,082.50. Okay, well, if we know we're at 1,085 and we can go to 1,082.50, that's 2.5 points. What's our risk? We already know that if we take 100 of these trades and only 40 of them work out, we're going to make money. If 50 of them work out, we're making gobs and gobs of money, right? So let's look at this. How do you spot this? You look at the swing point here, and you take a look at what your indicator's doing. You look at when it makes new highs, you see in relation to the previous high where the new high is coming in. And when you see this thing start to head back down, and you don't get the confirmation until this bar is completed. So I said we were spotting low risk tops and bottoms, not that we were getting the absolute top or bottom, okay? So we're spotting low risk. You don't get much lower risk than, 1.5 points in the Russell. If you're trading with a 50-cent stop in the Russell, you're probably going to get wiggled out of a lot of trades. You're not going to do very well. This is a very low risk top. Now, if you want to get smaller risk, drop this down to a 50-tick chart. I'm okay with 1.5 points in the Russell. I'm okay with a 20-point risk in the Dow. If that's too much for your account, then you can always drop down. Now, as you drop down, your skills are going to have to improve. Okay? So make sure you're trading at a rate that you can comprehend and you can spot. All right, so we've talked about this. We've looked at it in the market as far as structure goes. Let's look at a couple of my favorite trading situations. Now, I don't have a cheat sheet, so to speak, for you, but these are my favorite trading situations and the tools that I use to make sure I'm not getting too emotionally involved in the direction that the market's going. I'm trying to stay objective in the market. Now, are emotions part of your trading? Yes. I mean, I still get emotional when I get a big winner, or if I'm just can't do anything right that day, it gets a little frustrating. But that's part of the profession. So these are my favorite trading situations. Not every single one of them happens every single day, but they will give you a pretty good idea of where the market, when the market gets to these levels, it'll give you a really good idea of where you can step in and play to get the most bang for your buck. Okay, so I'm going to use this in conjunction with an indicator that I developed called the ricochet. It's a way for me to save real estate on my desktop and to not be looking at a bunch of different oscillators all the time, a bunch of different indicators. It just kind of pops up on my screen. So, but you can use this technique just by, if you've got plenty of real estate, and you can have the oscillator under there or a couple of different ones, you can spot these patterns without the indicator. It's just it's spotting the divergence for me, and it shows when it's present and the pattern is complete. Okay, Scalpers can use it to follow the trend. Longer-term traders may use it to spot reversals. And it complements other tools and filters like for your parabolic moves. So if you've got a market that's fallen out of bed like we had this morning and you get to certain levels, then you know that the market's probably going to take a breather. It's probably going to at least retrace, if not bottom up, produce a bottom and trade back up to where it came from. Okay, I like to refer to those as V tops and V bottoms, and sometimes they can be a little difficult to trade if you're not careful. So let's talk about the three-step pattern, and we're going to bring it all together right here. The first thing I said is you had to identify the trend. Well, these are nothing but moving averages. They have a little different calculation, but if you put exponential moving averages on here and the fast was below the slow, you have a downtrend. Okay, and like I said, I don't like to make things complicated. I like to keep things simple. So in my world, if this little ribbon right here is red, I'm looking to short the market. Okay, so I've done my job in identifying the trend, right? That was the first step in the three-step pattern. I told you we've got these building blocks. Now we're starting to stack them on top of each other, and eventually it's going to look like a house, right? So we've got the moving averages are in agreement to the downside, so I'm looking for shorting opportunities in the market. That's step one. Step two is I need a trigger. Well, we've talked about divergence, so let's use divergence as a trigger. So we get this up move, we get this retracement, we get a close, and this is hard to see in a bar chart, but a bar chart lets you see more on the screen than a candlestick chart does, so I like the information there. But you can see we get a simple price pivot because we have a lower close, and then it spikes back up, right? It spikes back up to the high, and right here, this is the ricochet. This is where it's going to ricochet off of that price level. It means, and all this means is the indicator of choice. In this instance, I think this was the CCI. The CCI was putting in a lower high as price was trying to go higher. In the context of a downtrend, we know right here the market's probably going down. And if it doesn't, we've got the risk defined as the top of this range. Okay? Same thing right here. The channel or downtrend is still defined. You get a move up, you get a head fake, and then you get another move up that gives you one tick higher high and then a rollover. So at this point, now look at this trade. We don't know this is a completed pattern until right here. So look, does it go down and everything's just wonderful? No. It actually comes back up, but it never takes out this price level. Why? Because the bears are in control. That's what this price pattern does. It tells you who's in control. And as long as you're below this particular level, this 16,290-ish, the bears have the market under control. The market's has selling pressure, and it's going to continue down, making lower highs and higher and lower lows. Okay? Now, obviously, everything's going to come to an end, but this gives you a really good entry, a place to take half your profits, move your stop down to your entry, and then trade, risk-free for the rest of the way. And that comes into your supervision of your trading plan, which I'm not going to talk much about today. I'm sure there's different ways that you've been taught to trail your stops and to take profits at certain levels. So that's one thing that I am going to do, though, is I am going to show you where the triggers are in a lot of these trades and why they're good triggers versus just arbitrary triggers. Okay. Now, well, let's talk a little bit about your counter trend plays. This is a bullish divergence. Do we care about this? No, we ignore these because they're not in the context of the way we've identified the trend. Okay, so again, this is a complementary indicator or complementary skill set to have. It's not a standalone. You don't want to just every time you see bullish and bearish divergence, you want to be going long and short the market. It's got to be in context of, number one, where the market came from, and number two, do you think there's an increased probability that you could continue in that direction? So let's talk about those probabilities a little bit and talk about where key levels can end. I've already said pivots are something that if you got them in your toolbox, you can use them. I prefer the ATR. So what I do each morning is I take the average true range and I add it to the close of the previous day. And I subtract it from the close of the previous day, and that gives me the range that I can reasonably expect the market to trade in. Really, really cool levels. Not a whole lot of people look at them. That's why they work so effective, because statistically, 93% of the time you're going to close the day within 120% of that ATR level. So if you get outside of that, you've got a really, really good chance of reversal. And that's the first and foremost, that's the highest probability that setup that I have, is when we're outside of the ATR levels. When you're outside of, and you can use some proxies, if you're familiar with LRC channels, if you're outside of the Bollinger Bands and you spot a bearish divergence or bullish divergence, that is a great time to initiate that trade, because once you're outside of those levels, yeah, price temporarily can run a little bit, but it's not going to sustain that momentum forever. And when you're spotting tops and bottoms, that's the key. You're trying to spot when the market's running out of steam or where it's statistically likely to reverse. So here's a chart pattern that I had one day where we were sitting here in the trading room, and price just kept going up, kept going up, kept going up. And the 16,309 was 100% ATR, and the 16,352 was 120% ATR. So I kept being patient, and I waited and I waited. And finally, we got a divergence signal. This was, I believe it was a MACD divergence or something like that. And the ricochet triggered. And so I took the trade, and I knew my stop would be outside this ATR level. And I was like, well, that's really good, because the chances of us closing up here are very small. And you can see that I had to sit through from this was a lunchtime trade, but 12:40 to about a little after 1 before the market actually broke in my direction. But I was able to get risk-free in about 10 minutes, because as soon as we got down here to this little swing point, I wanted to reduce my risk, take half the position off, and move my stop down. Okay, and like I said, that's part of your management technique that you can implement. If you like that structure, be my guest. If you don't like that structure and you just like to use a fixed amount of points, then all you got to do is look to your risk. How much risk, and try to go for that much reward. Okay, so your ATR levels are good places to spot turning points. Highs of the day and lows of the day after the first hour and a half are pretty good places in the stock index futures, not so much in gold and crude. And I know I'm throwing a lot at you, but you can either jot it down or you can email me after the presentation. We do have some cheat sheets. Well, I don't really have a complete list of cheat sheets on one sheet, but I do have some tips I can give you in email if you're interested. Market structure. Here's the ag market. You've got a red slingshot channel, so there was pressure on the day to the downside after being up in the grains. You get this little consolidation, you get bearish divergence, bearish divergence, bearish divergence. You get 3 opportunities to short this market. It never breaks structure, and then it heads lower. Okay, this is actually value chart divergence. Whoops, I want to go back to the previous thing. So these are examples that I've pulled to make it easier for me to discuss this. I do want to take some time and show you some live markets that we looked at today, and one in particular, well, I'm going to start with one, and that's the gold market. And you can see right here, gold had a pretty, I would say, a pretty impressive day, didn't it? On a 5-minute gold chart, this is today's price action. We got outside of the ATR. Obviously, 37 points is more than gold moves during the day. But look at from 9 o'clock in the morning all the way till 10:30 at the movement that you had, and we were outside the ATR level. Okay? We were comfortably outside the ATR level on this particular break up. And if you don't know what the ATRs are, it's pretty easy. You can just plot an ATR. Well, I've got time. I'll show you real quick. So on TradeStation, you can sit here, and it's real easy. A lot of the things have it. You can insert the analysis technique. We can come up here, and it's called average true range. So you come up here, and you look for average true range, and this particular indicator will give you gold on a 5-minute chart, and you don't want to look at these on 5-minute charts, but it moves about 50 cents every 5 minutes, right? Well, you back this up to a daily chart. We can come up here and we can do, whoops, we can do daily, and you can see 25 points is about all gold moves. So you add a little bit of fluff to that. 27, 28 points gives you the range that gold normally trades in. Now, what happened today? Well, today we got outside of that. So what I want to look for, I want to look for tops, correct? Well, look what happens in the chart here. You get this move right here, you can see with the ricochet from this swing point. Remember I said it took a swing point to start your analysis. And then you're looking, okay, well this high is getting stronger. Look at these, in this case, the CCI. Look at what's happening to the CCI. It's saying you can buy this if you want to, but it's going to be short-lived, right? So when you get this completion, you know that it's probably going to go down. Now, this doesn't look like a lot, does it? Well, I'm here to tell you, in gold, you're looking at 1233 half to a spike low of 1226. So you're looking at over $600 in the move right here. Now, if you drill down after you saw this, if you drill down, you could have, there's a couple of other places you could have got an entry. The 144 tick chart showed divergence as well leading up into this. So you could have got in with about a 2-point risk in the gold market. So would you risk 200 to make 600? And spot it in counter trend trading on top of that? I would. And then if you wanted to trade with the trend, you later on this day, you actually had another situation here on the 5-minute chart. You had a situation where it didn't quite offer you the explosive move, but it gave you a lower risk trade because right here we had a bullish divergence on the 5-minute chart in gold. And again, this was a very low risk entry because you knew right here that it was going to complete. So 30 to 30, so there's $400 with only 28, 21. So with a $200 risk, you got double your money. And so I wanted to show you these because this is not something that, you know, I can really make up and put into the presentation. It just happened today. But it happens in a lot of different markets. You can look at the Dow and the Dow was a nightmare today. But on this particular chart, we got some moves right here, and then a lot of these. Let me clean these fib levels were really important for us in the trading room today. They're not so important. They're cluttering up the chart. So once we bottomed out, we're outside of the ATR levels. Okay, we're outside the normal range of the Dow. So we start looking for bullish divergence. Why? Because we got a higher likelihood of closing higher than we do of going down and making new lows. Okay? Now, you only have this situation. You don't want to, like if you're up 50 points on the day, you don't want to get caught shorting the market continuously. Those are the days you can kind of get run over. So that's what I wanted to kind of show you is when you combine this trigger, if you will, with identifying the trend and spotting the phase of the trend, it can be a very, very, very powerful indicator where you can risk a little amount in order to make a substantially larger amount. Now, does it work all the time? No, we get those anomalies. You get black swan events from time to time. However, if I can lose $200 and occasionally make $600, $700, I can operate at a 40% win rate and still be a profitable trader. And I talked about the why is important. Well, the why is me controlling my risk in order to support my family. Okay, and this is what I do each day. I sit here and look for these opportunities, and it doesn't have to be in the Dow or the S&P. If you're a crude oil trader, here's crude oil today, starting a little bit before lunchtime. You had a downtrend. You had crude break to the downside. You had a bearish divergence here. You had bearish divergence here. Now look, you had some good moves back to the upside, but the most money was made by shorting the rallies. So we ignore these because we know which direction the market is more likely to continue. Okay, so let me jump back into the presentation here. Where is that at? I think I might have hosed it up. Let me see if I can get back to it here. Here we go. So those are some examples, both present from today as well as some examples that I wanted to show you from a teaching perspective. And what I want to offer you today is the ability to dive into it a little bit more. I've got a couple of recordings that I've done. They're on demand. it's going to look about like this. So you've got the benefit of a couple of live sessions that you can learn from. And what you'll get is you'll get a page that looks similar to this, where you'll have some recordings as well as a bonus indicator there. Okay? Now, what I'm doing is I want to offer this at I guess this is like a Christmas special. So you get 2 recordings of on demand. You watch them whenever you want to. The page will be there. You will learn how to determine the market direction, when to place your trades, and how to manage the trades. Okay? You can take me up on this, and I'm going to give you the price here in just a second. The link is www.tradethesystem.com/learn. We sold these trainings. I actually did a special for my members at $197. So it's 2 of them. So it's 197 times 2. So that's almost $400. And this indicator, we used to sell a lot of the indicators, and we've gone to pretty much, we like to give away the indicators if you'll take the time to learn the methods to use them. So I'm going to give you a package, an indicator package that includes the ricochet, like I showed you on TradeStation. It includes the price channel, which is the TTS, the CCI, the RSI, the MACD, and the stochastic divergence. That's all 5 indicators. You can install one of them or multiple ones of them. You can have multiple on your chart. You can just format them a little differently. That we do have them coded for TradeStation, Ninja, and Thinkorswim, and with very, very little customization, you can import the TradeStation ELDs into multi-charts. So we're going to do that for $97, and this is, I don't offer that for $97 very often, but it's only for the first 30 people, because I know this is going to generate questions, and my email box, you know, I can only get to so many people. So between now and the end of the year, we're going to do this special $97 for the first 30 people, and you can pick that up, www.tradethesystem.com/learn. After you view the recordings, we have a 100% money-back guarantee. If you don't think that this is a good method, and I'm going to ask that you just be, I'm being pretty generous for you, I'm going to ask that you just be honest with me. If you do not think you got $97 worth of information in the form of indicators and training, I want to give you your money back, because I don't want you having something that you're sitting there looking at and saying, oh, that Michael guy got me on this one. That's not what this is about. This is about helping you succeed in 2015. And what if you don't feel like it's going to help you with your trading plan, if you don't think it's going to help your entries and exits, then I want you to just call me up and say, look, Michael, I don't think I can trade. I don't think this is going to benefit my trading. No questions asked. We'll credit your account, and you'll be good to go. All right? So unfortunately, I can't see the questions, but if you guys have any questions, I am available, michael@tradethesystem.com or support@tradethesystem.com. www.tradethesystem.com/learn gets you access to that page that I showed you. You get the indicators immediately. So if you click on that little click here to see the bonus indicators section, you can download the indicators immediately. And what you're going to see here is you have the TradeStation indicators on top, you have the zip file for NinjaTrader, and then you have the ELDs for TradeStation. One subscription gets you all 3 platforms. I don't have a platform fee. That's one thing that I do get a question a lot. So if you've got Thinkorswim and TradeStation, you can apply the studies to both of them. Now, I will tell you, TradeStation looks a little different than Thinkorswim and Ninja. Each platform has their own little nuances. Instead of getting these little dots here, you actually get a little arrow with a circle box telling you when bullish divergence is. So it's still showing you the same thing, but it shows you in a little different manner. That's just the differences in the charting packages, but I don't want you to be surprised when you get that. So I don't know, there's no way I'm going to be able to see the questions. So with that said, let me just go over a couple of the frequently asked questions and see if I hit upon yours. And if I don't hit upon your question, then all you have to do is email me, michael@tradethesystem.com. Give me a day or 2 to respond, and then I will get back with you with your questions. The first question that I get, the main question I get is, why do you see green dots with no blue or red dot? And that's because divergence was present, but on the last little down move, the indicator went lower. So it's just showing you it's not complete, but divergence was present. Another question I get is, what time frames does this work on? This works on minute charts, tick charts, volume charts, whatever you can deem a swing high and a swing low out of, it will work on. Now, the oscillators I only have coded for those 5 that I showed you. If you have another indicator that you would like this applied to, I can work with you to get that, but I will tell you it's pretty expensive to get it coded, per indicator. So you're getting a really, really good value by getting all 5 of these in the same package, for $97. That equates, like $20 an indicator, and I don't know many people out there who are willing to put their time into the development, for that amount of compensation, because it definitely cost me more than $97 each to get them coded. What other questions do I normally get? Can you have, a lot of people want to ask, will this show up even if the oscillator's not there? And yes, it does. It's a standalone indicator. It will show up on the price chart whether you have the oscillator on there or not. I choose not to have the indicators on there because they fill up the screen and I can't see price. I like to blow price up so I can see it, and I don't want to have to worry about a bunch of subgraphs. What are some other questions? Does it work on stocks? Yes, it works on volume stocks. So if you've got a stock trading less than 100,000 shares and you're trying to trade penny stocks, you're probably not going to be very happy with the performance here, because those stocks, they're not going to be liquid enough to give you rational moves. They're more of your momentum type plays. You're going to try to just go with the momentum that you've got there. Once again, the link to take advantage of this offer is www.tradethesystem.com/learn. I appreciate you guys' time. I appreciate your attention, and I hope you gained a nugget or two out of the presentation. And I look forward to working with Cyber Trading University again. I want to thank them again for having me and opening their client base up, their customer base up to where they can benefit just like we do. We love to share information, and we love to always, we like being sponges. We like getting information from other sources all the time. So it's a great community, and look forward to working with those guys again. I appreciate your time, and that's all I have for today. So you guys have a great trading tomorrow. Good luck, and we'll talk to you at the next training session.